We begin with our top story. Stocks looking to keep up momentum in the second half after gaining almost 15% this year. JPMorgan's David Kelly writing this. Neither consumers nor investors are behaving as if they are scared. Investors have pushed the S&P 500 to an all-time record high 33 times already this year, while consumers have maintained a personal savings rate of 3.6%. David is with us around a table. David, good morning to you.
Morning.
A lot of people coming on the programme talking up a consumer slowdown, cracks in the labour market. Why shouldn't we be fearful of that?
I don't think we should be fearful right now. What we're seeing is a small downshift in growth. We have a problem at the lower and middle income consumers. And if you look at consumer non-durable spending, things like food and clothing, just the basics, that was actually lower in May than it was in December. So we can see that slow down. But at the same time, we've seen tremendous wealth gains. And we've also seen tremendous wealth gains. We've seen a lot of payroll job growth, a lot of wage income growth. So as I look at the consumer spending will grow more slowly, somewhere in the 1.5% range going forward for the rest of this year, as opposed to 2% plus. But that's still enough. And so I think all that's happening here is the economy is slowing down to a little under 2 in terms of growth, a little over 2 in terms of inflation, but it's still pretty good.
So slowing, not slow. Can you tell me the difference between normalisation and something more sinister? What would that look like? What would change your mind ultimately?
Well, this is a very stable sort of. It's kind of like this very stable machine that sort of just pumps out twos in terms of growth and inflation. What could change that is something will change it. A shock, or B, a big policy change. I mean, we're just talking about I do think that what happened on Thursday meaningfully increases the likelihood of a Republican sweep in November. If Joe Biden is the candidate, it's quite possible a lot of independents will stay at home, and so Republicans will sweep. Now, if they sweep, if you take Donald Trump at his word, you've got much higher tariffs. And now tariffs are a elixir for stagflation. Tariffs slow growth and push up inflation at the same time. If you took him at his word on immigration, the economy would come to a halt because of deportation of unregistered immigrants or illegal immigrants. So, but I'm not sure if we can take him at his word. I think history suggests that perhaps it would be optimistic, or not optimistic, but it would be foolish to take him at his word in this stuff. But still, it's something to think about. I mean, some policy shock could absolutely tip this economy into recession.
Hold on a second. John said that basically Friday was the first day of this election cycle, at least for markets. How much do you actually rearrange what you think about how to position markets as a response to this idea that you think that there is a greater likelihood of a Republican sweep?
It does make a difference. I mean, let me give you one example. The 2017 tax cuts. If Joe Biden is re-elected, then some of those tax cuts will be extended beyond 25, but not all of them. If Donald Trump is elected, I expect that whole thing to go through. And if you add that to what the CBO is already looking at in terms of the growth in the debt as a share of GDP by the early 2030s is going to be about 135% as opposed to 122%. So you're going to have significantly more debt if we extend all these tax cuts, and that means a higher level of long-term interest rates.
So in other words, are you more bearish on long-term bonds right now than you were, say, Thursday morning?
Yes, I think it would be a rational thing to be that way. Yes.